Tell us a little bit more about what Jeff Gundlach has been saying, because he's now predicting the 10-year Treasury yield could move towards 3% by year end?
He says, yes, by year end, it could move towards 3%. He didn't say it would get there necessarily, but he said toward 3%. And he also said 3% is definitively bear bond or bond bear territory. He's, he predicted the bottom of the market would have been a year ago, almost exactly a year ago, when 10 years were trading for like 1.2, 1.3%. And so they've been climbing, and then they've had their ups and downs, as the chart showed. But now it seems like there's maybe a breakout period when they'll resume their upward trajectory.
And this began with, it seems, the European markets, and what we got was that stumble from Mario Draghi, seemingly confirmed by what we got today in the ECB minutes, and that there was some cautiousness about what they do about the asset purchase program and looking for the exit. Did he give you any sense of kind of what the drivers here are in terms of a greater spillover for these bond markets? Is the United States on its own? Yeah.
Yeah, he did say the problem is there's this divergence between the U.S. and European rates, and he said it shouldn't be there. I mean, if you look at how Europe has grown and how the U.S. economy has grown and the projections for where Europe's going and where the U.S. is going, they're very parallel. And, basic rates should reflect what you can earn above economic growth. So the problem is, like, European rates are very, very low, and U.S. rates have been relatively low. So somewhere they got to get together. And I don't understand all of the forces at work, but basically there's this divergence between the U.S. and Europe, which would close because of the paths of growth of both their economies.
Right, and there's a lot of technical levels here at work as well that he's paying attention to. We mentioned the 50 and the 200-day moving average earlier for the 30-year bond. What else did he tell us?
Well, it was just a short couple of email exchanges, but basically one thing that he wanted to make very clear is that he predicted a year ago bond rates had bottomed long term, that we're going to be climbing, and that this continues. While there have been ups and downs, that U.S. rates are headed up in the 3% direction, and I wouldn't say there's no stopping them now, but that's where they're going.